Okay, so you've found a company that looks really interesting. You've done the reading, you've checked out the business, and now you are face to face with the single biggest question that every single investor has to answer.
Right. How do you actually figure out if a company's stock is a fantastic deal, maybe just fairly priced, or dangerously overvalued? That is exactly what we are going to break down. Because look, valuation isn't about finding some kind of crystal ball. It's about knowing which questions to ask. The best way to think about valuation is not as one single magic formula. It's much more like a toolbox. See, each tool inside has a very specific job, and a smart investor knows exactly which one to pull out for the task at hand. So let's grab our first tool. This is probably the most famous one in the whole box, the price to earnings ratio, or just PE. Think of this as your quick gauge. It's the first thing a lot of people look at just to get a quick feel for a company's valuation. And the formula itself? Well, it's pretty straightforward. You just take the company's current share price and divide it by its earnings per share. So, let's say a stock is trading at 20 pounds and the company earns 2 pounds per share. Well, its PE ratio is 10. Simple as that. But here's where it gets interesting, because the PE ratio has these two sides to it. On one hand, it's an amazing shortcut. A PE of 10 literally means investors are willing to pay 10 pounds for every 1 pound of that company's profit. But, and this is a big but, here's the trap. A low number doesn't automatically mean it's a bargain. It can also be a massive warning sign. For instance, imagine you see a struggling retailer, and it's got a PE of 5, while the rest of the sector is trading at an average of 15. Your first thought might be, wow, that's so cheap. But what the market is often pricing in is a really grim future, the idea that its profits are about to fall off a cliff. So that low PE, it could actually be a red flag for a business in serious trouble. So if PE is our quick gauge, think of our next tool, EV-EBITDA, as more of an X-ray. It's designed to look past the surface and see a company's underlying structure, especially its debt. Now, I know it looks complicated, but the concept here is so important. EV stands for enterprise value. And unlike the market cap, which is just the value of all the shares, enterprise value gives you a much truer picture. It adds the company's debt and then subtracts its cash. It basically tells you what it would really cost to buy the whole company, debt, and all. And why is that so useful? Well, it lets you compare apples to apples. A utility company that's loaded with debt can now be fairly compared to a software company that has none. But it has its own hidden trap. EBITDA ignores something called capital expenditures, or capex. A company might look cheap using this metric, but it could be burning through mountains of cash just to stay in business. Think of a telecom company that has to constantly build new cell towers. Okay, this brings us to our third and most sophisticated tool in the box, the discounted cash flow, or DCF. If the other tools are looking at the here and now, DCF is all about drawing a blueprint for the future. It's an attempt to figure out a company's value based not on what it earns today, but on all the cash it's expected to generate for the rest of its life. The whole idea here boils down to the time value of money. We all know this intuitively, right? A pound in your pocket today is worth more than the promise of a pound a year from now. So what DCF does is it takes all of a company's projected future cash flows and discounts them back to figure out what they're actually worth in today's money. If we break it down, it's kind of like a three-step dance. First, you have to forecast, or let's be honest, guess, how much cash the business will make for years and years. Second, you pick a discount rate, which is really just a number that reflects how risky you think those forecasts are. And third, you do the math to see what it's all worth today. Think of it like this. Let's say you expect a business to spit out 100 million pounds in cash 5 years from now. Well, if you use a 10% discount rate to account for all the risk and time, that future 100 million pounds is only worth about 62 million pounds today. And that's discounting in action. So here's the crucial point. The DCF's greatest strength is also its absolute greatest weakness. It forces you to think like a disciplined, long-term owner. But your final valuation number is incredibly sensitive to the assumptions you make. If you change your growth forecast by just a little bit, or tweak your discount rate, your valuation can swing wildly. It's a powerful thought experiment, not a magic number generator. Okay, now for what might be the most important part of this whole thing, knowing when to just put the tools down. Because sometimes using these standard valuation metrics can be more misleading than helpful. I mean, you absolutely cannot use a PE ratio on a startup that has no earnings to begin with. For really cyclical businesses like miners or airlines, these ratios can make them look super cheap right at the peak of a boom, just before they crash. And if your DCF model is built on pure guesswork, it's not a valuation. It's just a fantasy dressed up in a fancy spreadsheet. So after all of this, what's the single most important lesson? When you're trying to navigate all of these numbers and ratios, what do you use to guide you? Well, you need a compass. And here it is. This is the master rule. A number on its own is totally meaningless. You have to understand the business, the industry, the economic environment, everything. The story behind the numbers is always, always more important than the numbers themselves. Context always beats ratios.
You see, these tools don't give you the answer. What they do is help you ask better questions. Use P/E for a quick check, switch to EV/EBITDA when you need to compare companies with different debt levels, and save DCF for when you have real confidence in the future. So I'll leave you with this. Which of these valuation tools has confused you the most on your own journey? We would love to hear your thoughts.